Welcome, everybody, and thank you for joining us SF Live. My name is Kai Hoffman. I'm the CEO of the SOAR Financial Group and the @Junior Mining Guy on Twitter. Really appreciate your time. Thanks for joining us. We got a fabulous guest again lined up for you today. Really looking forward to speaking again with our good friend Brien Lundin, Jefferson Financial. He's the editor and publisher of the Gold newsletter and also the host and producer of the fantastic New Orleans Investment Conference. Personally, can't wait to go in a few short weeks, mid-October, down in New Orleans. We'll get to that, and I'll have Brien explain a bit more who's presenting because the lineup is superb. Really looking forward to that. And we're going to have a lot of great topics lined up, lots to talk about. We actually had to stop our brainstorming session before hitting record here because we were going all over the good content already, and we needed to record some of it so it's not duplicate for us, and we got some fresh ideas and content for you here as well. Before I switch over to my guest, follow us on YouTube, follow us on Twitter. Hit that like and subscribe button. Leave a comment. What do you think is happening in the world? What do you think is happening with the gold and silver price on the physical and the paper trade side as well? And how do you think it all play out? Also, if you have an opinion, share it with us in person in Frankfurt, Deutsche Goldmesse, November 18th and 19th. We're putting that on in person, as I said, 35 companies, 6 fantastic keynotes. One day I'll get Brien out as well, I promise. And we'll have him present his findings and his theories as well. Really curious now to hear him. And Brien, it's great to see you again. Thanks for coming on the show.
Great to be with you as always, Kai. Thank you so much.
I think I spoke very fast just now. I just really rushed through it because I wanted to get to you, actually. Really looking forward to this conversation.
Yeah, lots to talk about and commiserate about and bemoan the markets now. I mean, the last time we talked, we were a lot more excited about gold and the metals and everything else. So I'm praying that you won't revisit too much what we said the last time. I think it was in March.
End of March, yeah. And looking at some of the charts, I think we marked the top there.
That's great. Well, let's hope we mark the bottom here then.
Let's hope so. You might be a great indicator here, and if that happens, I'll definitely bring you on whenever I need a trend change. So,
okay.
No, fantastic, Brien. Well, you brought it up actually. Let's revisit March at the end of March, and as you said, we were quite euphoric. We were in a great mood. We were at a conference in Las Vegas, obviously, but gold and silver were trading well. And you had mentioned, and I titled the video that silver is being squeezed at the moment, or at the moment of the video, and what happened? I think we dropped below $18 as we were recording this today.
Yeah, so silver will follow gold. I think these silver squeezes have a short-term effect, but what really has the effect on silver are the monetary issues that push the markets and that push gold. So what you really want to look at for silver and really everything else in junior mining stocks is what's going to happen with gold, where is it heading? In March, we were kind of anticipating or just getting the first Fed rate hike. I think when we talked, it was probably just around the corner.
I think it happened 2 weeks prior. I think the first one was March 16th. So
yeah, and no wonder we were excited because we had about a 2-week run or rally because of the Fed rate hike, because gold kind of counterintuitively tends to perform very well during a Fed rate hike cycle. That's what the record shows. And I think it's because the speculators kind of lean off of it, get off of its back as far as shorting the market, because they short the market before a Fed rate hike, then they kind of get out of the way as the Fed is hiking rates. So we should have, if the past record was indicative or would have held, then we would have had a nice rally in gold. We did not, because for a few reasons. One, I think Russia invaded Ukraine, and then the gold price soared, and all of us, experienced hands in the market like you, knew that that's really a false reason to buy gold, and it's just going to fall back once that situation either gets resolved or the geopolitical crisis gets boring to the market and moves on. And that's exactly what happened. But I think that injected a lot of noise into the signal that we kind of expected from a monetary standpoint and a fundamental standpoint. And then because that issue kind of faded in the public's consciousness, at least in the financial markets, that downtrend and it just kind of continued from there. Also, what happened was that the Fed was surprisingly determined to hike rates. and we did not see the Fed put come into play. And I think that really surprised the markets. And I'll credit to Jerome Powell and company. They were a lot sterner than the markets really thought they would be. And that's weighed on all of the markets. So, and it's not any great consolation for gold bugs, but gold's only down about 6% or so since the start of the year, and most other markets are off to a much greater extent. So,
massively, they're off massively.
Comparatively, it's done better.
Like copper as well, like because the recession looming as well. Dr.
Yeah.
Copper's been hit hard, right?
Yeah.
A lot of it is like has to do with a strong U.S. dollar as well. And
absolutely.
One thing as well, like how do you explain the U.S. dollar strength? Right, like the U.S. is sort of flexing a little bit, I think, on the monetary side, that they think they can raise interest rates, the economy will be fine. Where do you think things are headed, and do you think the U.S. dollar will stay as strong, or maybe even grow stronger?
Yeah, it's exactly what I said. The Fed's determination is in hiking rates. It's led all of the other central banks. It started tightening before them. It's tightening much more quickly than they are. So it's really natural that would happen. And as the value of the dollar goes up, those debts that are denominated in dollars remain. So the demand for dollars doesn't go away even as the price goes up. It's kind of price insensitive. So there's not a real barrier to it rising. Now, when we say dollar strength, we're talking about the dollar index, the DXY, and that really is just a weighing of the dollar versus its trade currencies. That said, the dollar's been good by the real measure, which is the dollar value of gold. So gold's kind of traded sideways to down, and that reflects dollar strength in a very real way.
It's like, Brian, like, how do you see this all playing out? Like, debt obviously is increasing. We're trying to tighten, but that's like treading waters. Like, it's just drop in a bucket. I don't think it'll make a difference.
Mm-hmm.
How do you see this playing out? Like, where is this headed? Like, it feels like there's no textbook written about where we're at right now, and everybody's sort of trying to make up an explanation, trying to understand and piecing together economic theories to make sense of it all, right? And where do you see things headed? What's your theory?
Well, we have to recognize that all of the markets are driven by central bank monetary policy. And to a large degree, all markets are driven by the global markets, driven by U.S. central bank policy and U.S. markets. So the Fed is driving the bus here. And in fact, it has to an ever greater extent over the past few decades. And so what is the Fed going to do? You need to analyze it from a standpoint of where's the Fed headed? And I think they've reached their limit, or just about reached their limit. I don't think they have more than one more rate hike, whether it's 3/4 or 0.5%. One more, maybe two, because the cost of servicing the federal debt is at a much greater level than ever before. People compare today with the 1970s, and one of the things that I've been talking about recently is that Jerome Powell has shown that he probably has the same cojones as Paul Volcker had. But the problem is he doesn't have the same tools. When Paul Volcker was cranking up in interest rates to kill off inflation, the federal debt was at about 30% of GDP. Today, it's closer to 130% of GDP. So he really can't raise rates very high because the cost of servicing the federal debt will absolutely explode all of federal spending, take up all of federal spending. And it's already gotten there. People have not been tracking this, but I have. And just recently, the last quarterly numbers, federal interest payments have soared to $600 billion a year. And that is the highest level ever. It just spiked based on the first couple of rate hikes that the Fed has instituted. So what we're seeing now is the cost of servicing the federal debt is already at a record level and soaring straight up. Yet the bulk of the Fed rate hikes, all of those 3/4 point rate hikes, have not yet been factored in because these are quarterly numbers. So once we start to see that, once over the next couple of months, once we get the next update on that, I think that's going to become a dominant theme in the financial markets. You're going to start hearing about it on CNBC and the like. And I think that's when the Fed is going to get a lot of pressure, not only internally from a central banking standpoint, but fiscally from Washington and politically. And I think as that cost of servicing the federal debt reaches toward $1 trillion a year, then you kind of get to a political a barrier where that they cannot cross. And they will, if not, have to pivot and actually reverse. They're going to have to stop and change their rhetoric and say, we're just going to coast for now. And I think that would be enough to reawaken the gold markets. But importantly, that will be an admission that the Fed is essentially powerless to fight inflation because it can't get interest rates above the rate of inflation. And once the markets realize that, then this easier money policies that the Fed pursues and has pursued for decades won't also be bullish for equities, for bonds, for everything else, because you'll still have that inflation genie out there out of the bottle, and the Fed proven that it can't fight it. So that only leaves really tangible assets, and primarily gold and silver, as what I think would be the investments of choice in that kind of a scenario.
Very interesting. And let's spin it one step further. And I proposed to you, like, well, back in Germany, 1929, we had the experience of hyperinflation. And that's why we love gold and silver, and it's imprinted in our DNA. But like, how do you get out of this massive debt that's hanging over the U.S., Japan too? How do you get out of it? Like, and I proposed, like, well, inflation can be the solution if you look at it, and hyperinflation might help you get out of it. But you suggested, and I'm quoting now, deflating versus defaulting, right? So that's another theory as well. I'm just trying to see where this plays out to. Like, as you said, like, there's going to be a ceiling. Maybe it's $1 trillion, maybe it's two, who knows? But at some point, there's going to be a ceiling that we can't service the debt anymore, and it's spiraling out of control.
Yeah, absolutely. And this is the same recipe, the same prescription that civilizations have pursued throughout human history. This is nothing new. People today are the same as they were in ancient Greece and ancient Rome. You know, we, instead of being on financial Twitter, we were walking around in togas in the forum and talking about how the world's going to hell in a handbasket. So everybody's the same. What worked then, or what they tried then, and the problems they faced are the same, and the prescriptions are always the same. They deflated the currency when they spent too much on, you know, wars, bread and circuses, et cetera, et cetera. They created too much debt, so they deflated the currency. Back then, they just used less silver in the silver denarius in Rome. And that process took a couple of hundred years in Rome. And we look at that as, when you look at the charts, looking back in history, we look at that as the default, when it really was a slow depreciation. And that's happening right now. The dollar's lost about 88% of its value since 1965, when it completely took silver out of its coinage. So it's going on now, just like we saw in Rome. The question is, does that really do any good, or is that kind of a depreciation of the currency more a sign of the process going wrong? Does it really get you out of trouble? It really does not do away with the debt unless you get into that kind of Weimar-like hyperinflation. Because consider that if we had 8% inflation a year, which is very high. So we had current rates of inflation just ongoing. It would take 10 years at that rate to deflate away 50% of the value of the debt. And that's if you're not creating ever more debt, which of course you will be. 10 years at 8% inflation a year is not something that is going to be pursued by a policy by the central bankers, because they won't be around very long in that process. They're essentially signing their own career death warrant. They're going to be out of power. So it really isn't so much a solution as it is something that they kind of fall into, because they keep spending money, and that keeps creating more money. The U.S. right now is in a classic debt spiral. You know, we're going to be spending close to $1 trillion a year just to service the debt that we currently have. So where are they going to get that money? They're going to create more debt. So we're adding $1 trillion a year. I mean, we're already in a deficit spending situation. So if we have $1 trillion deficit just on the basic budget every year, we're going to be adding another $1 trillion or so on top of that deficit. So we're going to be borrowing another $1 trillion every year to pay the interest on the debt that we already have. That's a classic debt spiral. And so, it's not going to resolve itself. I don't know whether it's going to resolve itself in this cycle or the next boom bust or the one after. But what we have to recognize is that this is a process that has gone on since really the guns and butter era of the 1960s. So we have 50 plus going on 60 years of a ever depreciating dollar, ever more currency being created. And right now, things are happening very quickly. So the water's been draining out of the tub for 50, 60 years. And right now it's going very quickly around the drain. That's the gurgling sound you hear. So whether it's going to happen now or whether it's going to be in another 5 years or 10 years, I don't know. I don't really think anybody is smart enough to know. But I think we can be pretty confident that we're going to want to own gold and silver and the associated investments going into that cycle.
Interesting. Like so far, we've talked very domestically, like what is happening in the U.S.
Yeah.
Right? I think there's one more curveball out there, and that is when the U.S. loses its status as a world currency, as a world reserve currency.
Mm-hmm.
If that happens, I doubt it will happen because I think the U.S. will fight tooth and nail to keep it the U.S. world currency or the world currency. Yeah. But it seems like China, Russia, or the BRICS, including Brazil, India, and South Africa, are sort of working on their own deal, so to speak, their own currency or something in the background to sort of compete with the U.S. dollar. How would that factor in? Because that would it feels like it would start or accelerate the spiral.
Yeah, it would, but I think we're mixing cause and effect. I think the dollar losing its reserve currency basis would be the effect of that spiral going on more quickly than it is in other currencies. I'm not a big proponent of the fact or advocate of the fact that the U.S. is going to lose its reserve currency status at any time that really makes any difference to you and I. I mean, it's probably an inevitable process. But it's not so much where the economic power lies, but where the rule of law lies. And that's not going on the old, 11 aircraft carrier argument for the US dollar. I think it's simply a matter that as bad as the US is, and as much as we've seen US use sanctions and around the world to impose its will, it still has the best rule of law globally out of all of the options for a global reserve currency. So I don't think that Putin and Xi will have much luck trying to get either a yuan or a ruble reserve currency out there, just because their governments and their economies are driven by, which side of the bed their leaders woke up on that morning and in their reactions. And that's not the kind of an environment that in which business can really be done. You have to have an idea that you have some court of law where you can resolve disputes fairly. So I think the U.S. will resume and preserve its reserve currency status. But the issues that I'm talking about are more of an entire fiat currency issue. I think all fiat currencies are going to lose their credibility because they're all headed down the hill at varying rates. It's just a race to see who gets there first, but they're all going to end up at the bottom. And the only way eventually to establish or reestablish credibility for a currency like that is to reestablish some connection with gold. So that's kind of the end game. That's kind of the reset that people talk about.
No, the Great Reset or the Big Reset, depending on who you speak to, sort of includes that as well. And what is your opinion? Sounds like you are a proponent of going back to like a gold standard or at least partial gold standard. Does silver play a role in that as well?
Yeah, I think if there's a number of 20% of M2 or whatever, if it backed that, then you could establish a link between the dollar to gold, and that would imply a gold price of $10,000 an ounce or something like that. That sounds like an awful lot now, but $1,700 sounded like a really high number 5 or 6 years ago, or in 2011 or thereabouts. So I think we can get there over the course of this next cycle, which I think is going to be years in length. It is workable to have a currency pegged to gold, but what you have to do at that point is periodically you have to reset that tie. It can't go on forever and ever, because again, governments will overspend and they'll need to create more currency, et cetera, and as their economies expand. But they can do that by just changing that number that links it. The reason why governments have not done that or maintained some link to gold is because every time they change that number, that value of gold, that's an acknowledgement that they screwed up, and they're actually devaluing the currency. It's much better for them to have it go on in the background through inflation and depreciation of the currency, because then they can blame it on the previous guy in office or the next guy in office. Nixon did not need to sever the dollar's attachment to gold. He just needed to recognize what the real value of gold was and reset the price. But he temporarily at least cut the dollar's attachment to gold. And I think it's going to be proven temporarily, a temporary measure, because it's eventually going to have to go back to some sort of a link.
Do you see any indications of that happening yet? I know Russia and China are obviously buying gold, but I don't see the US. At least I haven't heard any official numbers, US buying any gold, or any of the other, let's say, US dollar countries. Although that question doesn't make a whole lot of sense, but the US is not buying gold.
No, they're not. They got plenty. They've got enough to do it right now, and it's valued at what is it, $40 an ounce or whatever now. So they could solve a lot of problems by simply revaluing their gold reserves, at least from the balance sheet perspective. But then again, who cares about the U.S. balance sheet? Right now, they're operating under the process that you don't have to worry if they run out of money; they'll just make more, and that's what they're doing now. Again, that leads to a loss of credibility for the currency eventually. And again, I think it's not just the dollar; it's everybody.
Yeah. Now, one reason I actually love talking to you as well, you have great insights into the physical space as well, gold, silver in particular. What is happening on the physical side? What do you see happening there right now? And that maybe brings me a little bit to the theme of your conference as well, sort of an extension of that. So
yeah, I things are tightening up. The commercials are getting less short across the metals. The stockpiles in the vaults are getting low. In the PGMs, interestingly, they are. So I think that from that standpoint, the setup for the metals is looking good. Again, though, the monetary issues overwhelm everything. They are what we need to look at, and I think the big key for the gold and silver markets right now is Fed policy and what's going to happen over the next couple of months. Interestingly, I think it's going to be perfect timing for this year's New Orleans Investment Conference. I wish I could say I planned it that way, but I think we're going to be very fortunate in that respect, and that's going to be kind of a key turning point. I expect to be talking about a absolutely soaring cost of servicing the debt by the time of our event in October.
Yeah, mid-October. I think we have the next FOMC meeting September 21st, I believe. So we should have a few jobless reports or job numbers out before then as well. So really curious to see that. One last one, maybe on the physical side, how have premiums developed for physical gold and silver? Do you have an eye on that as well?
Yeah, they've come down. They were absolutely obnoxious. They've come down a good bit, still kind of high in silver, and you have to shop around for availability. So the premiums are very high. That's more a sign of the inability of government mints to keep up with demand. So, strangely enough, government mints are not good business people. So they always have a problem. Yeah, they always have a problem with inventory control and the like. And these are manufactured products, supply chain difficulties, yada, yada. So when you have these issues that come up that create a big surge in demand, then all of the supplies get wiped out and you have to go into aftermarket, and premiums go to the point where it really doesn't make sense even to buy silver, when you have to pay so much for 1 ounce of silver.
No, I was looking at, I think it was roughly 10 days ago, I was on First Majestic's website and they were selling silver with no premium. So I was doing the conversion and it was pretty much spot on a spot level at $19. So
That's a great bargain and should grab that. I was talking with Keith about that at Rick Rule's event in July. And that's a great program that he does, but he does a great job of managing their business. There's only so much he can do, as far as keeping silver back from the market, because there are costs involved in that as well. But he's a great business person.
absolutely, definitely get some eyeballs on the company. But Brian, I want to give you a chance to speak about the New Orleans Investment Conference. Obviously, you talked a bit about your theme, what you will be talking about. Who else do you have presenting, and do you have an idea what they'll be talking about?
Well, yeah, I have an idea. I think they're going to be talking about central bank policy and what's happening with that, because it does drive everything. But this is another great event. Kai, I know you are on social media and financial social media all the time, and you see all of the really smart people out there. I think that these extraordinary times have brought out some extraordinary people to comment on what's going on. And I've been in this business long enough. I know who the really smart people are out there, who's doing the best work, the best analyses, whether we agree with them or not, the best, most well thought out arguments. So we got them all here. I mean, just about all of them. There's only one or two that I really wanted to get to the conference this year that I was not able to get. But so far, we've got Jim Grant, Doug Casey, Jim Iuorio, Dave Collum, George Gammon, John Najarian. I'm reading off this list right now, so pardon the squinting here. Tavi Costa, Lawrence Lepard, Dominic Frisby, Adam Taggart, Bob Prechter, Adrian Day, Brent Cook, Peter Boockvar, Danielle DiMartino Booth, Brent Johnson, Rick Rule, Jim Rickards, Nick Hodge, Lobo Tigre, Mike Larson, Jeff Clark, Gerardo Del Real, Jim Stack, Sean Broderick, Mickey Falk, Byron King, yada, yada. The list goes on and on. I skipped a bunch on there because I can't see them.
What a lineup.
But it's
great.
I mean, literally dozens and dozens of the top people out there. And one of the things I stress to people as well is it's not just all the information you get from the stage. The audience, and in that environment, it's kind of a destination event in New Orleans. It's a great place to be, a lot of fun, great music, great food. And having all these people come from all over the world who, just by the very nature that they are there, they kind of self-identified already as really smart, really active, and independent thinkers. So being in that environment, talking to your fellow investors who are seeing what you're seeing, it's just invaluable. It really is. And just a wonderful event. The intellectual energy is just amazing.
No, absolutely. I've been there before. I can't wait to go again in about 5 weeks time. And we'll put a link to the registration down below in the show notes as well. And can't wait to meet many of the guests or speakers you have on the program that we've had on the program here at SF Live as well. Meet them in person, and we'll definitely do a lot of interviews at your conference as well. Just really looking forward to that.
Hope we can get you across the border this time.
Yeah, no, I think it looks good. I need to book my flights though, but
Yeah,
I'm definitely coming.
Didn't you get stopped at the border that last year?
I did. I was in Europe 9 days before and trying to enter the US during
yeah.
the rough COVID times. So I missed it by 5 days. So
yeah, they had to have a quarantine period, I guess. Yeah.
Schengen area and the US didn't mix very well back in October last year. So
right.
No, well, definitely coming out this year.
Clear to go this year. None of those hassles this year. Everything's back to normal.
No, and I'm looking forward to it. Brian, I really appreciate it. It was a fantastic conversation. Thanks for entertaining and humoring my interesting and crazy ideas and or questions. Really appreciate it. And can't wait to see you in a few weeks down in New Orleans. All the best.
Always a pleasure, Kai. Thank you so much.
Good luck with everything. And everybody else, thank you so much for tuning in. We had a great conversation with a fantastic Brien Lundin. Brien Lundin or Lundin? London, Brien Lundin. Right?
Yeah, I say London instead of Lundin to try and highlight the fact that I'm not in that mining family. So
yeah,
and they appreciate that fact, by the way.
Fantastic. I know you get that a lot. So, but I keep stumbling over it. But I know it's London, so I know it. I knew better. So everybody, thank you so much for tuning in. Follow us on YouTube. Follow us on Twitter. Hit that like and subscribe button, and Thanks for tuning in. We'll be back with more.